In this video, we're going to talk essentially about financial analysis. And we're going to do it probably in parts. I don't know yet because I haven't made a video. But that's essentially what we're going to do. So let's look up here for a second. The first three sort of things or topics we've already done. So I did another video. So let's just get rid of them. Gone. In this video, we're going to talk about parts 4 to 7. And yes, take a good look because I changed parts 4 to 7 since the last time you've probably seen this list. In 4, which I want to do first, we're going to talk about the analysis process. A very targeted, straightforward process that can be as either simple and quick or as complicated as you want. The next thing we are then going to talk about is how to compare, well, I guess first the awareness that a firm's results can actually be different from how the company's sort of publicly traded stock can perform, at least in the short run. And then lastly, how do you actually, and I'm mostly just, this is just going to be a short conversation, but because it's fairly complicated, but like, how do you pick a stock? Like, how do you come up with the idea? And lastly, then we're going to kind of essentially loop back and come into the analysis into step 4 again and look at everything with sort of what we've talked about in this course. In other words, receivables, inventory, and so on. And then the end of each new topic, so next is our long-term assets, capital assets. We're then going to come back again and go, okay, so what extra understanding can we add now that we know something about capital assets? All right, so without further ado, 4, the analysis process. So what I want is you to go on the syllabus and I want you to find the analysis tool right here and then the financial analysis sort of process, and then get those open. And when you're ready, unpause this video and we'll start. So for those who are ready, here we go. This is what the financial analysis tool, we've already used it, right? We've started to take it with Kira Corporation, and we've looked at this because I'm going to flip back and forth a little bit once we get a little bit through this process. Here is the financial analysis process, and essentially there's different ways of doing this. For my students, I break it down into these 5 or 6 steps. The first one is obtain all the financial statistics, and yes, you can actually get every single one online from somewhere, but you don't actually know when the numbers were produced to create that. So are they using 12-month-old, so year-old numbers, or are they using 3-month-old numbers? You don't know. So unless you can do it yourself, you don't know. And that's what this tool is for. Right? You quickly throw in maybe, 5, 7, 11. 11 numbers. 11 numbers, and you can do the analysis for a year. Right? 44 numbers, and you can do it for 4 years and get a trend, a really decent trend. So don't rely on something like Yahoo Finance or something else unless you know for certain the numbers they're getting and when they're from. Okay? So the second step is once you have all those numbers and understand, I'm going to put this out here. This is this is the most basic analysis you can do. You can do more if you need to or are able to or want to. Right? But this is the big picture. In reality, for the first few years that you will be using this stuff to invest, you might only have a few $100s to put in any given company. So like how many hours are you going to spend doing this? So next one is when you have those ratios and statistics, look through them for red flags. And by red flags, I mean things that stand out for good or bad reasons, right? So a consistent positive trend, a consistent negative trend. The lack of a trend is a trend as well, right? And then 3, look through the information such as what you would find in the management discussion and analysis, right? That was something in the scavenger hunt. They go on and on and on about all sorts of things. You can also find external analysts who have looked at the company. So once you have your own brokerage account, or even nowadays online for free, you can find analysts who have approved or disapproved of the company and give recommendations about whether to buy the company's stock or not, and whether they're in for a tough year or not. Right? Next, once you have these statistics and you've spotted the red flags, can you interpret them? What's causing them? And might that be for a good reason, a bad reason, something out of management's control, something that's likely to be temporary or not? Lastly, If you decide that, yeah, this might be a good company to invest in, this is one of our topics. A company can be doing well and its stock might be doing poorly or too well that you don't want to buy it yet because it's too expensive. But in the short run, what a company is doing in terms of its performance as a company, making profit, can be different than what the stock is doing, which doesn't make sense now, but that's one of our topics. We'll come back to it. So, last, once you've made your decision, you either choose to execute, buy, hold if you already own the stock, sell, and that's if you're an investor. If you're someone that's thinking of lending the company money, there's different criteria. But the last thing, which we'll spend very little time on, is just make the decision based on the previous 5 points. But what we really need to focus on here is what to do and in what order. So let's expand number 2. Look for those red flags. And what do you look at first? The first thing you actually look at is, in normal times, are these things. These are the vital things to check normally. Okay? So the first thing is revenue growth. And you can freeze this. You can also check out, like it came from the syllabus, right? So if I scroll up here to the syllabus, it's right here. This process of financial analysis. You can take time to read it or you can pause the video and read it. I'm not going to read everything. I'm just going to give you the shortcut. The fact is that future revenue, what the company thinks they're going to do in the future, is usually the most important thing. And that often comes from press releases. Sometimes it's in the annual reports. But this is one of the most important things to understand. If you're going to invest in a company, to understand that markets don't price in the past. A stock's price does not incorporate what has happened. It incorporates what people think is going to happen. So future expectations are what are reflected in the stock markets and the bond markets and other financial markets. Not what's happening now and not what's happened in the past. Only what people think is going to happen. That's part of the problem I just mentioned, that the stock and a company's performance can be out of sync in the short run. Right? So the reason, of course, is the next one, B up there, is revenue growth. Because ultimately, all of these things are basically saying the same thing. That for you to increase your wealth as an investor or the owner of a company, your company has to increase in wealth. In other words, make profit, because that's what net income is, right? Profit is the increase in wealth, not cash. Wealth. So if a company gets more valuable, it's because it's made profit. And how do you make profit? Well, you hopefully sell something for more than it cost you. So that means you have two things to control. One, costs, which is important, but there's only so much you can cut. Only so much you can do to keep costs down or cut them. If you really want to grow profit, you have to grow customers. You have to grow revenue. So those two things are super important because at the end of the day, they translate into more profit, which means a more valuable company. So the future revenue growth and the future profit per share, EPS, earnings per share, are the most important thing going forward, normally. And then next, if you're going to increase profit, your past revenue growth as an indication of how well you're doing at achieving what's coming in the future, right? And then C is margins. So profit margins, gross profit margins, operating expense margins. Those things tell you about how the company's run, how profitable it is, right? So if you have high profit as a percentage of sales, it tells you two things. One, either you're really good at cost control, or you have, it's a marketing concept, you have pricing power. So your product is really loved. It's easy for you to charge a lot of money. That's an important thing when you compare how well your company's done to, say, competitors, right? The next most important thing, and oh, by the way, there's certain calculations you do to figure this stuff out. Again, our tool does them for you. Now, if we switch to our tool, real quick, we see down here we've got them. So if you put in the right numbers up here in blue, it's going to tell you what is your growth, revenue growth, earnings growth, and here's our margins. Our gross profit margin, our operating income margin, and then our return on sales or our overall profit margin. Okay? And I'll tell you right now, by the way, if you haven't got something ready to take notes during this video, it means you're going to have to watch this video again. So you might want to pause this and get that out. So revenue growth, these numbers can only come if you've used this section. And I'm going to tell you right now, when this video is made, of course, it's coronavirus time and nobody knows what's coming. They cannot figure it out. Nobody. They have opinions, but nobody knows for sure. So no one is going to give guidance because they can't predict. They have no idea. So this is gone, which means all these values, you're not going to get them. You don't know what revenue growth is going to be in the coming future, in the next year. Nobody has any idea. So then what's the next most important thing? Profitability. Gross profit tells you how much profit you're able to make after the cost of generating revenue. So for a merchandise business, that would be sales minus cost of goods sold equals gross profit. So the gross profit percentage would be, what's my profit based on my total gross sales? Operating profit tells you just something a bit different, right? This operating income percentage then takes away regular operating expenses. Now, operating expenses are usually in management's control because they're internal. So this is really cost control. This one tells you cost control. And the last one is just overall. How profitable are you? Right? This first one, gross profit, just to reemphasize, this one tells you either how much pricing power you have or how much control your suppliers have or you have over your the inventory that you're buying to then resell, or a bit of both. Right? So it's really suppliers' power, pricing power, cost of the materials that you then sell to customers, or your own pricing power because your brand is really popular and you're able to charge a large price, like Apple for its phones, for example, right? Those things, that's one of the most important things to check normally. The next most important thing to check is what's going to keep you in business long enough to achieve what you think is going to be, your goals or how well the company's going to do. So if you think, oh yeah, this company's great, it's going to grow, but you have to survive long enough for those ideas, those dreams, those projections to come true. In other words, the company can't go bankrupt or run out of cash before that. So the next thing is then safety and cash flow is really what safety means. It means liquidity and solvency. And there's a whole bunch of ratios that measure this, but the most important one is, can they pay the debts that are coming up in the future? And by future, first of all, the next 12 months, and then the next 12 months after that. So the most important thing to check, as you can see up there, your first priority is, can they pay everything that's due in the next 12 months? So that's current liabilities. Can they pay it with current assets? No? Okay. Can they, if you then add on how much cash flow you expect in the next year plus the current assets, can they pay? And if they can't, then run away because that's a problem, right? There's then other things you can check to see how efficiently they're managing their cash, like accounts receivable turnover you can add. So if you go back again to our tool, notice the only one that's there is the number one priority. And then a more longer term measure is, do they have too much debt? Because too much debt is eventually going to become a problem, right? If anything goes wrong and you're sitting with too much debt, which is most corporations in the world right now, then you could have problems, right? But this first test, 12-month cash available, which is quick ratio plus cash from operations. Is that big enough? Is that as big or bigger than your current liabilities? Because both of those things, that's the numerator there is how much cash you're going to have, you have now or will have over the next 12 months. And the denominator is how much you have to pay in the next 12 months. There's more, though, you can add. So if, for example, Kiera sells everything on credit, so accounts receivable turnover might also be important. The thing is, it's not up there because most companies don't actually tell you how much they sell on credit, which makes that ratio impossible to calculate. And then not every company is a merchandise business, so their the inventory turnover ratio is not as meaningful. It's like, in Kiera would be an example, right? Their inventory, well, that's not true. Some of their inventory is petroleum products and natural gas, but some of it's also just pipes and things to do repairs. So in that case, if that's what inventory is, it really means supplies, and it's not something you need to calculate inventory turnover on. So that's why they're missing. But by all means, if you think it's important, you can add more ratios. You have a lot, right? On this reference sheet here on our syllabus, you've got all the ratios that are here on this link, including all the common size numbers, right? So you can go more in depth if you want to. So next, after cash flow, what's the next most important thing? Well, the notes. And I'll tell you why. There's other irregularities you want to look for. So for certain types of businesses, you want to look at their research and development costs. right? If it's a cutting edge technology company, they have to stay competitive. So they better have pretty consistent levels of R&D, or at least as good as their competitors. And then notes. So if you see the R&D, in other words, you see the R&D spending as a percentage of all expenses starts to fall, you should start to get nervous if it's a long-term trend, right? But the notes are really important, particularly for retail companies, because in the notes there's a couple of really important sections. And you can find other things. This is the row here in grade 12 accounting that is really important. Is where most of the new learning comes from, because we're incorporating our deeper understanding of numbers, like where do you get bad debt expense from, and how do you value inventory. That stuff you need extra information from the notes. But there's some other secrets that you should know as well, and I'm going to say them right now. There's two. One, there's a trick to figuring out how obsolete or efficient or out of date or old assets are. Right? So one is you would look at, for example, amortization. You don't always get it on the balance sheet, but you can find it in the notes. So if, for example, you have $1 billion worth of assets at cost and the accumulated amortization or depreciation is half that, the company is essentially telling you those assets are halfway through their useful life, which means they're old, will soon need to be replaced maybe, or they're inefficient, maybe not as efficient as their competitors. That's a good trick. But even more important than that is something called contingent liabilities. Let me show you. So by way of illustration, let's take a look at Lululemon, right? A Canadian company that's only listed on the New York Stock Exchange, so it doesn't have a Canadian listing. So when you do that, you have an American listing, you have to file something called a Form 10K. That's what this is. It's a standard form, everything's in the same place, but it's essentially an annual report. So if you're looking at a U.S. investment, where you want to look for some of the things that we have examined, Item 8 in Part 2 is always, because it has a standard form, it's always your financial statements. So if you click there, there's the statements. The notes then follow that standard procedure in all annual reports, international reports, right, under international accounting standards. So this thing, if you look at a total liabilities. This is what I want to show you. Total liabilities are right here. $638 billion. Sorry, $1 million, I think. Let me check this one more time. In thousands. So that's million. Yeah, 638 million. There's all their, this is here, there's their current, in total, 638 million. Their assets are well over 3 times that. Right? So that's like a really low debt ratio, right? So you would think. Okay, here's the thing. Until you check contingent liabilities, you don't know anything else that's out there. Because of the full disclosure gap, it's required that anything important has to be disclosed. You have to tell investors and creditors about it. So in the section that's for contingent liabilities, major lawsuits that are pending have to be written. But there's also something important for retailers or certain other types of businesses, and that's leases and rents. Right? Stores like Lululemon, those stores are often not owned. They're rented. But a rent contract is not a debt. It requires you to make a payment every month, just like debt. If you don't have the money, it can send you into bankruptcy, just like debt. But it's not on the balance sheet because you never borrowed anything. So this debt ratio, if you just glance at it, it's less than 30%. It's like 30%. But if you add in how much they have to pay in the form of rent for all of their stores, suddenly the commitments rise. So you can't look at a company without looking at contingent liabilities. And one of the easiest ways to find it is just do a Control-F search. Contingent liabilities. And you can, until you find it, you can find probably, there's only two. One, two. If you put in rent, you could find it. You know what? It would have made sense if I had actually found it before I started play, but that's fine. We'll find it. Contingent lease obligations. Obligation. I have to go here. Index for notes. Commitments and contingencies. Note 16. Here it is. See, it's almost always in the notes. Operating leases, minimum rent, Total, $750 million over the next, it looks like, 4 years and beyond. Right? So it costs you money to break a lease. It's a contract. So that puts there, it's not a debt, but it's very much like a debt because you have to pay that. They have to pay $783 million before their leases expire. Which if you add it on to the $600 million, it means their debt ratio is starting to get, or at least their payment ratio is starting to get close to their total asset value. This plus the 600 and whatever million is about 1.4 billion in obligation. Right? So that's a whole other story. That's a very different story. So then when you're working with, say, a tool like this one, and your debt ratio comes in at 20%, you need to go to the contingent liabilities and obligations and then fudge this number. Add in those leases, add in the rents, see what your debt ratio becomes. Right? Because they have to pay it just like a debt. So you might as well fudge this number and see what that debt ratio really looks like. So for example, up here, if we had total liabilities, it was what? 600 and I don't know what was it? 600 and whatever. Yeah, 638. So I'll put in 638, $638 million, and total assets were 2,000 and something. I don't even remember what it was. Financial position. Consolidated balance sheet. The total assets were 2084. Okay, so total assets was 2084, so $2,084 million. Total liabilities, $638 million. That gives us a debt ratio of about 31%. Except now, when we go and we add in, I don't even remember what that was, but if we add in 638 plus all those leases was 700 and what? I don't even remember. Lease. Where was that? Let's just do set. Let's say it was 738. I can't remember the number now. But let's say it was 738. It was 700 and something. Now their debt ratio, if you consider that to be just like debt, now it's like 2/3. Totally different picture. Totally different story. Completely different conclusions you would draw. Right? So this is the type of stuff you need to understand. So this is also the type of stuff that most people can't do. Some simple lessons about accounting, simple knowledge of accounting's terminology structure, what goes into the numbers behind the scenes. I mean, you've seen how long this annual report is, right? Most people don't know what's in that. But a couple of key things, and you can make much better decisions than the average population, right? So the last thing then, after this is it. So once you've looked at amortization, gauged the age of assets, looked at those contingent liabilities, and you've looked at those critical things, revenue growth, margins, cost control, pricing power, cash flow for safety, and then lastly, those hidden things and notes, you've done a pretty good analysis. You can then draw in what other people think too, because you can find what other analysts think online now pretty easily. There's lots of sources, right? Even Amazon has analyst ratings, what they've said. And if you have your own brokerage account, you'll have even better access. So that's essentially how you do an analysis. Normally, as I've said a few times, in a world where the stock markets have crashed, you kind of have to turn it upside down. And what you look for first is safety, because you're looking for good companies that probably have good profitability, at least going into it, good pricing power, cost control going into it, understanding that they might not make profit at all for a year or two, because maybe nobody will, right? But you want strong balance sheets, which means good cash position, low debt ratio, able to pay their debts coming due in the next year or so that they can survive the crisis, survive the problems, and come out on the other end. Because when they do, they're likely to be stronger than the competition because they were going in, right? They were running their business model better going in. They were strong enough to get through because of their balance sheet, their cash position. So when they come out, they're likely to survive, first of all. And when they come out, they're probably going to be better run than just like they were before. Those are the companies you're looking for. And in what industries? Well, that's a whole other conversation. So that's it for topic. What topic was this one? 4. Okay. Part 5. Valuation. And I've kind of talked about this a little bit in a previous video, but it's really for the long-term investor. Again, for a short-term investor or trader, you don't care. You don't care about accounting. You don't care about fundamentals. Not much at all. But for a long-term investor, you do care about valuation, because how much you pay when you first enter a position, an investment, really matters. Like if you overpay, so if you were to buy at the top of the housing market and then the housing market crashed, as many Americans have done 10 years ago, it can take you a long time before you're before you've even broken even. So valuation does matter. And what is valuation? Well, there's a whole bunch of different ways, but the most common one, because it's a pretty good estimate and it's really quick and the math is simple, is the price to earnings ratio. Right? Again, where you take the stock price now, or when you bought it, whatever, usually now, and you compare it with some measure of earnings. And there's different ones. Like there's the last 12 months. There's what the next 12 months are projected to be. And then the one that was in the last video was the cyclically adjusted price to earnings ratio, which is the average annual earnings for the last decade. That's your denominator. And then you kind of get this idea of how much are you paying to make $1 of profit a share? And as you've seen this image, the less you pay, the chances are the better off you're going to do in the long run. And so sometimes the best time to get into great companies, emphasis on great, which is where you draw on your accounting knowledge to pick those great companies, the best time to get in is when everybody's panicking, because that's the only time you're going to get like price to earnings ratios of 10 or lower for good companies. So the thing is, I mean, the good times can be a decade long. You can't just not invest for 10 years. So how do you pick good companies along the way? Well, still, valuation is if a company is growing, its stock price can be growing. It can actually be going down, or it can be growing slower, or it can be growing faster than the actual firm. And this is one of the most important. This is the part that confuses investors. There'll be a news release. The company will say, "This is how much profit we made. This is what our revenue did. Here's what we did." And the stock, and it was great, much better than last year. And the stock goes down, and it blows people's minds. It's perfectly logical if you understand why. So a company's stock can be going up, right? Which is a function of supply and demand and speculation. And people think a company's great, so they keep buying the stock, driving the price up. And then the report comes out with its annual report, its financial statements, and they give guidance maybe about the next year. And it was good, and the guidance is good, but not as great as everyone expected. So expectations got ahead of actual company performance. And so the stock comes back to reality before proceeding up higher again. That can be a perfectly logical reason. It happens all the time. Companies can get ahead of themselves. The stock price can get ahead of the company's performance. But you know what happens the other way too? People can panic and the stock goes down too far below the company's worsening performance. And then the company, sorts some stuff out, fixes things, gets on the turnaround track. And the stock realizes, oh, it's not going to be that bad. And the stock, which is overshot, now comes back up. So day to day, quarter to quarter, financial report release to financial report release can be very, very noisy in terms of data, right? But for a long-term investor, one way to start this out is to stick to the valuation concept. Okay, so in this, which you've seen 100 times, in this analysis tool, there's something you can use as a long-term investor to figure out if a company is overvalued, undervalued, and what longer-term trends are. Because it can be really difficult to weed yourself through information and news reports to figure that out. And they're on these pages. And you can choose to use them or not. I do. But here is the data page. Okay? And here is the chart that is produced from this data page. So first, where we're going with this. Let's take a look at this chart. And this is for Apple. So there's a demo on here for Apple. And it goes out to, if you look at the x-axis, I think just prior to the start of 2020. Okay? So the most important thing to understand, to remember, is that what's shown on the y-axis is not dollars. It's not money. So it's not a stock price and it's not earnings per share. What it is an index. So in statistics and indexing is a very handy tool. It's where you take the first data point and then you divide every other data point after that by the very first one. And so you're actually comparing what's happened to the starting point. So for example, here, the blue is the stock price and index value of the stock price. Up there it says $391. That's not $391. It means the stock price on that date, November 19th, is 391% of where it was on my very first data point. So it's 390% of the original value. So if you see the original value for both earnings, the red dots, which are earnings per share for the year that just ended. So for example, this red dot is the earnings per share for the year that just ended. 2015 just ended. Apple reported, and its earnings were not $144 per share. They were 144% of the very first data point I have, right? So the first earnings per share in red was 100, and the very first stock price was, I can't find it because it's hidden behind the red one, but it's about 100, right? The very first one is 100. So everything's indexed to the first value being 100. And so you can see very clearly now, and this covers years, right? You can do this for years and years. You can do it for a decade. You can see the stock going up, and earnings are rising, and the stock is rising. But if you look at the trend, income's projections downwards. So the year here that just finished, reported here, they must have given guidance, or it started to fall before that, right? Apple stock started to come down before that. So people were probably getting indications from other sources of information that Apple was going to have maybe a tough year or so, and the stock price came in. Did it again here. Look at this. Up, getting way, its earnings are rising. It's a growing company. But this was too fast. This was faster than company performance. This exuberance over 2 years, and don't think it's just going to turn around because it's overvalued. This was too fast, but it took 2 years for people to decide, okay, this is too fast. And in it came. And guess what? Same thing. We're way ahead again. And these were projections into the future when I made this chart. And by the way, those projections have actually been withdrawn because nobody knows what's going to happen after the coronavirus, right? But this can help you decide if you are overpaying for a company or not. You could even throw a line on here that measures price to earnings. How much bigger is the stock price to its future earnings in the next year? You can track. Is the stock gone ahead of its trajectory of earnings per share? Because if it has, then you probably don't want to own it. At least not yet. Wait for it to come in a bit. It almost always does. Right? Every time it got too far away from that trend line of actual real life earnings, the stock price reverted back to the trend. And yes, this process was several years long. But you got your chance to buy it at a more reasonable value if you waited. So how do you make a chart like this? Well, you can use this file, but I'm going to show you how to do it on this page. So you got 3 columns that you manipulate. The first one is column A, and all you do is you put dates in there. The second column is the closing stock price. Right? And the third column, and you don't touch these ones in white because they're the ones that calculate stuff so that you can make the chart automatically. This third column is the earnings per share, and you get that rate from the annual reports. So you might have to get a couple of annual reports to see that number. That's all you have to do. So where do you get all these numbers from? You can get them from a few spots. The easiest is Yahoo Finance, right? So if you put in Apple, all the information for Apple comes up. One of the options is historical data right here. If you click it, you can then pull data, as I did for that tool. I pulled every day's closing price as far back as I could, about 8 years worth, right? And so in this column, I put the date, I put the closing price here, and then I just put the earnings per share 12 months apart on whatever date their year end was. And that's it. It makes this chart for me, and I can gauge if my red earnings trend is rising too fast or too slow compared to the stock price. And it tells a long-term investor a good entry point, or whether a stock's too expensive or, wow, really undervalued, which is usually the case now. The problem is now you don't have the future guidance because people have no idea how to give reliable guidance. So, part 6, stock picking. How do you pick an investment? So there's many different strategies, but this is going to be short, just a conversation, just so you're aware of it. There's a top-down approach and there's a bottom-up approach. And top-down basically means you think of common, big picture ideas, big picture themes in the economy. Right now, with recession and coronavirus, some of your themes are things that make sense when people are stuck inside. So Netflix, right? Or things that people always are going to use some or a lot of, right? So toothpaste, toilet paper, who makes that stuff? Right? Colgate-Palmolive, Procter & Gamble, Johnson & Johnson. Or how about things that people just absolutely use no matter what, like electricity, natural gas, at least in the winter. So the other method is you look for companies with great numbers, great profit ratios, low debt ratios, and then you see what those companies are. And you decide, okay, do they have good future prospects? Do they fit into the broader economic story of what's going to survive, what's going to do well right now in a recession? That's the bottom-up approach. And that's essentially it. It's a lot more involved than that, but at this level of learning about it, that's all you need to be aware of. And so, in other words, it wasn't an accident that I picked Kiera. Kiera has the potential of being, so I did the top-down approach. I looked for companies whose services are probably still going to be needed, right? Because a lot of what it ships through its pipes, transports through its pipes, is not oil as so much as natural gas. And as last I checked, we're still going to have winter again, and we're still going to need natural gas for our furnaces, right? So the question is that good enough? So when you look at Kiera, you got to say, will they make it through this crisis? Will they make money still? Will they make lots of money after? What are the risks? Is it good enough? Is this the right industry? Probably. Is this the right company in the right industry? And that's what you have to decide. But picking stocks is really, you can either pick really great companies that are undervalued, or you can go then, that's bottom up, or you can pick top down. What are some themes that are emerging in the economy? What's going to be happening over the next couple of years? What companies will benefit the most if those trends prove true? That's top down. And that's, for you guys, that's really all you need to know. And finally, part 7, right? Back to our grade 12 content. And this is going to happen at the end of each topic. We're going to go, okay, so now that we know this new detailed information about accounting, how can we draw on that to have sort of a bit more of an in-depth analysis of a company? So let's cycle back then to Kiera. And can we incorporate the type? I'm not going to do it for you because I want you to try it. But can we incorporate, let's talk about the types of things you can start to incorporate based on what we've already learned. Okay, so here I am with receivables on one side and inventory on the other. So what types of things that we've learned about in these topics can we mention? Well, before we even mention these, let's mention revenue recognition. Because we understand that companies have different types of ways of recognizing revenue, and at certain points, you can look at those in the notes to financial statements. Usually, whatever policies you've picked, there's a whole section a company has on notes. It's often section 1. For Kiera, it was section 3, I believe. And revenue recognition indicated that they essentially recognize revenue when they've shipped the petroleum or products or byproducts to the customer, essentially FOB destination. But they also said they then bill monthly, which means all sales are on credit. That was helpful. Now, this company, we can actually do the accounts receivable turnover if we wanted to, now that we know that information. So then, what about these two? Receivables and inventory. What have we learned that helps us do analysis? Well, we know that both of these are essentially about cash flow, liquidity, in other words, safety, which in this environment, in a deep recession and maybe even another Great Depression, who knows what's going to happen? Safety is the most important thing. You turn everything on its head, from revenue growth, profitability, then safety, whoop, switches. If you are going to invest now, safety is the number one priority. You want the company you invest in to still be here in 2 or 3 years. Next, receivables. Obviously, right, the more you turn your inventory over, the more you can get your hands on your receivables. Because remember, accounts receivable or notes receivable, any type of receivable, is your money for paying your bills in somebody else's bank account. So the faster you turn over receivables, the less difficult it's going to be for you to get your hands on that money, especially in times when you really need it. But when you're in a moment like this, there's a couple of things you want to consider. So what is the method? First of all, you want to look at the note for receivables to see what the bad debt is. And it's very, very low for Keyera. It's not very high at all. The question is, will it suddenly jump? Because the oil and gas industry is in big trouble in Canada, in North America, period. But especially in Canada, because our oil it sells for less because it's less desirable, because it's heavy and thick. And anyway, so in that situation, what do you really want to know? You want to know how much cash flow are we really going to get from our receivables? And then that means you have to understand how they estimate what bad debt's going to be. Because one method is better for the income statement, percentage of sales. So when you're comparing profit from year to year to year, you know that whatever credit sales were, there's a portion that was put in there for bad debt just in case. Every single period. It's great for comparability, great for the income statement. But what we really need in this situation is we need to know what might go bad right now. And that is the percentage of aged receivables method. Right? And that's what Keyera uses. So that's a good plus. But the report that came out on 2019 is going to be totally different than 2020. So going forward, what's it going to be? Could it be 20%? Could it be 30% bad debt? Maybe. I don't know. But you got to do a worst case scenario. That's what you have to do. Look at the receivables. What if we didn't get 25% of that money? What would happen? Redo our statements, redo our numbers using the tool that you've seen several times, right? The quick analysis tool that we've been using, right? Fudge some stuff, see what it looks like. That's the whole purpose of spreadsheets, to do what if analysis. How about inventory? What about this? What if, again, it's a liquidity issue, right? When you buy a bunch of inventory and it sits there, you can't spend inventory. You need the money as cash to be able to spend it. So in a period where costs are changing, and they almost always are in natural resources, in this case, the costs have been going down, right? They've been going this way. So in that situation, FIFO is giving you the most current value. But Keyera uses average cost. So if prices have been falling and your ending inventory valuation is somewhere smoothed out average, there's a good chance in a serious, like oil gas, if natural gas prices and this oil prices have been crashing, if natural gas prices have been doing the same, and you're using average cost or LIFO, then there's a good chance that your inventory valuation, you won't be able to sell your inventory for that much, which means there may be significant write-downs. So in a period of dramatically falling commodity prices, if you have a huge amount of money in inventory, be prepared for some pretty significant write-downs to the lower cost of market, right? And the severity is FIFO will have the worst, average cost will have the next, and then LIFO will have the oldest stuff, which is the highest price. So it'll be written down. So did I just do that backwards? I did. Sorry. LIFO is the oldest. That would be at the highest price. It would need the biggest write-down. Next would be average cost. And the most current inventory valuation, because it keeps the most current stuff in inventory, would be FIFO. It should have the least, if any, write-down in a period of dramatically falling prices. Right? So Keyera is in the middle of the road, so there could be some significant inventory write-downs. But inventory is not that big compared to its total assets. So it might be okay. But again, you can fudge with that tool. Right? So that also means, because it's average cost, it'll be middle of the road for your profit. Right? There's going to probably be a big hit for a write-down on that inventory. They've had a write-down on inventory the last couple of years, so they're probably going to have a big one this year if natural gas prices have collapsed as well. So on that note, that is essentially all I want you to gauge about financial analysis, right? The total of all the parts of this video, right? Other than what's to come. So at the next topic we're going to do are capital assets, which means we're going to introduce a new amortization depreciation method. We're going to look more deeply into some things to do with capital assets, and then we're going to also incorporate some of that understanding into analysis, just like we did here with receivables and inventory, right? As always, let me know if you have any questions. Good luck.